Okay, everybody, let's go ahead and get started. Thanks for coming tonight. We have a good crowd. My name is actually Jeff Gibby, not David Darracott, but he was still signed in, and I just realized that. So anyway, welcome. We have a very special guest speaker tonight. I'm very excited to kind of introduce you to him. And as you know, we're going to read a little bit of a legal disclaimer for you before we get started. So today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Okay, there we go. Got that stuff out of the way. Thanks for coming again. I think we've had Bennett in the webinar room about 3 times now. I think this is his 3rd visit. And you know, we only invite back the people we really like. So I'd like to, it's my pleasure to introduce Bennett McDowell, a very good trader in his own right, author of 3 books, and somebody that's very, very well established in the industry. And as I always say, I'm gonna get out of the way and let him kind of talk to you today. So Bennett, let's bring it in here.
Okay, Jeff, thank you. Can everybody hear me okay?
I can hear you great.
Okay, good. Okay, I think everybody's good. Okay, good. Well, Jeff, it's great to be here. Thank you for having me. All right, good, good. All right, Jeff, should I take it away?
It's all yours, Bennett. Go for it.
Okay, great, thank you. All right, well, I just want to thank Jeff, and I do want to thank the folks at MetaStock for having me today. It's always a pleasure to be here. They have a great platform. It's a great product. You know, we have 2 of our indicators programmed for the MetaStock platform, and they're very popular, the OWL indicator and the PTF indicator. And these are 2 indicators that we design. One's for basically Elliott Wave analysis. It helps confirm Elliott Wave counts. And the other one is a precision trend filter, which indicates when certain highs should be exceeded and so forth. And you can learn more about these indicators. Our previous webinar here dealt with those. But today we're going to take a little bit of a different twist. We're not going to talk much about software, but instead we're going to talk about our approach to the markets. And this approach is a combination of different types of technical analysis. And many of you are using a trading approach on the MetaStock platform. And the nice thing about what we're going to talk about today are these are concepts you can add to what you're already using. In fact, we've built an entire service around this, and it's called the Weekly Trading Picks. And the Weekly Trading Picks is a great service, and I'm going to go into that in just a little bit. And we're going to talk about that. But a lot of folks that have trading approaches and so forth, they need help creating watch lists. And here is where the Trading Picks subscription service comes into play, because it gives them setups on stocks, Forex, futures, ETFs that they can use each and every week, and they're refreshed every week. And these are high probability setups. So we'll get into that in just a minute. But a quick little background on myself. I've written 3 books. They're out there in the marketplace today. The book on the left is A Trader's Money Management System. And this book is all about risk control. I'm a big believer in risk control. I've seen people take systems that are right just about 50% of the time, only 50% of the time, basically almost like a coin toss. And because they've had good money management and risk control, they're able to have a payoff ratio higher than 1-to-1, which makes even a break-even win-to-loss trading approach profitable. So risk control plays a very important role in trading. And so if you're interested to learn more about that, my book on the left addresses risk control regardless of the kind of trader you are, or even if you're an investor. The book on the middle is called The Applied Reality Trading, or The Art of Trading. And this is basically our book on the ART system, which is one of our trading approaches that we use. Survival Guide for Traders on the far right-hand side of this slide is basically a book on how to run you're trading at home just like the professionals do that run these hedge funds. In there, I've developed a very particular and unique business plan specifically for traders. And you can actually get a copy of that in the book. And we also give you a link where you can go ahead and download a PDF file where you can actually print or duplicate the business plan. So you may want to check those out. They're on Amazon. They're a lot of fun to read the reviews as well. All right, so here, my next book is the Elliott Wave. I'm also a big believer in the Elliott Wave. I think it's a great roadmap to the markets. And this book is going to be coming out probably later this year, early next year. And I'm putting the final touches on it as we speak, so to speak. And it's going to be a book all about the Elliott Wave, but more importantly, the Elliott Wave to some is a very complex form of technical analysis. And we're going to break it down and actually provide a matrix that I developed that puts a probability on different wave counts. So it takes the subjectivity out of counting the Elliott Wave. So that's going to be out in all major bookstores later this year, early next year. All right, a little disclaimer here. I know Jeff started out with one, but also two. We want you to know there is risk in trading. We have to say that, and of course that is the reality. But you know, without that risk, there's no opportunity. So the two go hand in hand. And so you have to realize that. We want you to trade with risk capital. We want you to use risk control. We want you to realize that past performance does not always equal futures performance or future performance. So you have to keep that in mind, and a good idea to test all the systems out there to see which one is best for you. Our topic for today is top secrets for picking effective trades. And as I said, we're not going to really delve into software so much as we are going to deal in approaches and how we approach the market, what setups we look for these types of effective trades. And basically the techniques we're going to talk about in today's session has really led so far our performance for our service that is really built around what we're going to talk about today for a year-to-date return of 909.55. And I'm going to put a link up a little bit later on in the presentation. I actually put it up before we open today, which will take you to the Trading Pick service. And also in that link there, you'll be able to click on the actual returns, the performance returns that achieve this 909.55%. So you'll actually be able to look at all the trades, the winners, the losers. And one of the things you're going to take away from this is how effective we are at cutting our losers short and getting out of those quickly, because not every trade is a winner, okay? We actually lose a fair amount of trades, but we're so good at our risk control that we're able to get out quickly and let those winners keep going on. So that's kind of interesting. I think you'll enjoy looking at that. I'll put that link back up there towards the end. Here are just some of our winners, okay, which is another example of really letting your winning trades run. So many traders, and it's a very hard emotion to fight, is they want to take profits quickly and get out of trades quickly. Whereas what we want to try to do is stay with those winners and take the opposite approach and get out of our losers quickly. And so when you win, you can win quite large, as what this particular slide is indicating here. All right, so the next question is, how do we do it? All right, well, first of all, obviously we're trying to find the best trading markets. What does that mean? Well, basically it's markets that are going to move or are moving quickly. And we have a whole approach in how to find these, from scanning the markets, for looking at certain analyst upgrades and downgrades, to looking at stocks in play and so forth. We're going to talk a little bit more about that later. Then the next thing we want to do is locate key entries, exits, and also locate profit target zones. And we do this through many forms of technical analysis, most of which is Fibonacci retracements for wave 4s when we look for Elliott Wave 4s, and also Fibonacci extensions when we look for Elliott Wave 5s. And then finally, we always use risk control. So that's a very important aspect of the actual part of the program. As I explained earlier, you can have a system that actually doesn't win very much, but with good risk control, you can do very well. So these are some of the things that we are going to cover today, but we're going to also talk a little bit more about how to uncover okay, these markets. What are the best types of markets to be in? And one of the key things we want to focus on is really what we're talking about here is momentum trading. We're not talking about investing. Investing's a whole different mindset and a whole different game. So when we talk about finding markets that are the best ones for trading using our type of approach, what we're talking about is markets that are going to move quickly. So it is momentum trading. And more traders equals more momentum. So the more news there is on a particular market, the more it's going to draw in traders. The more traders that are drawn in, the more possibility of getting big trends. Okay, Tesla Motors, TSLA, all right, is a great example of a stock that stayed dormant for a very long time. Then all of a sudden, the news started playing on how cool the car was. They make electric cars. Then all of a sudden, people were attracted to that. And there was a whole bunch of news out on that, and the market took off on that. So we do try to look for markets that are coming into play and are more visible on the news media out there. We also are constantly looking for emerging global trends, whether it's natural gas, whether it's oil, or any of that kind of thing. We are always kind of trying to get an idea, what's 6 months from now, what's going to be popular? Uncover emerging sectors, okay? What sectors are rotating? And it's not always a sector associated with an industry when we talk about this. For example, in the recent bull market run that we've had, we were getting up before the recent sell-off here, we were getting up on all the blue chip stocks to a point where any trades in blue chip stocks were actually risky because they had run up so much. So the next thing to do is to really focus on the stocks that have not run up. And to do that, we focused on sector analysis to see where the rotation was going. And it was going into stocks that had promise and had done well on the larger cap, but we're also now bleeding into some of the lower cap stocks in that same industry. And we did extremely well finding those lower cap and even cheap stocks that the money was rolling into to still take advantage of the bull market. So in late bull markets, you'll find quite often, all right, this sector rotation into the smaller cap stocks. All right, analyst upgrades and downgrades. Hey, you know, even though we're short-term traders, we still look at these upgrades and downgrades because if the upgrade or the downgrade is coming in sync with the momentum, then that's something we may want to consider because that's not only drawing in investors into that market, but also from a technical standpoint, if it's ready to move momentumly, then a lot of technical traders are going to be there too, which means you can get a very big trend. So we do look at upgrades and downgrades. Now you have to realize most of these upgrades and downgrades will not be good momentum trades. We have to find the needle in the haystack, so to speak. And what we do is we thumb through them all, and we maybe come up with one or two that may fit our criteria. And the thing is with upgrades and downgrades that you got to remember is that the analyst is really looking at a long-term situation of that particular stock in the industry, and of course focusing on management as well. But short-term, the markets could be chaotic, and they could be going against the analyst's recommendation. And so the momentum could be going against the longer-term trend that could develop in that particular market. So if that's the case, if they're opposing each other, all right, then we not necessarily want to be in that market. So we want to try to look for momentum going in the same direction as an upgrade, so to speak. So we look for those type of things. And then finally, we scan for specific market cycles. And we're going to talk about what these market cycles are. But many of them are channeling markets or basing markets that have been that way for quite some time. We know that when markets break out of these types of channeling or basing areas, that trends usually can be quite large. And so we look for those markets. We have a special scanner that scans for those markets. Okay. All right, so let's move on. and talk a little bit about entries. All right, when we talk about entering a market, once we find a sector and even a bunch of stocks that seem kind of in play, we still have to select the best time to get in them, the entry part. And so we actually use a combination or a matrix of technical analysis in order for us to decide what markets are the best setups and offer the best entry possibilities based on the risk of reward left in the particular momentum we're looking at. And so this becomes some of the work that we do behind the scenes, and it is something we also look at in both a bullish and bearish direction. You know, we don't always trade just long trades, but we look for bearish trades as well. So there's times when bearish trades will be better to take than bullish trades. And also this will encompass looking at the overall market and sentiment out there in the marketplace. Some of the patterns that we like to look for, all right, are simple breakouts. We like to look for buying coming in at certain Fibonacci retracement levels. We like to look at taking profits at certain Fibonacci extension levels. We like 1, 2, 3 patterns. This is where our pyramid trading points for the applied reality trading help us a lot. And then we also look for key areas to put our stops at. You know, one of the tricky things is with trend trading is trailing your stops, but not too close that you're taking out of perfectly good trends too early. So it becomes a little bit of an art of where to select your stops. And this is the kind of stuff that we do in our recommendations in the service that we provide. Patterns that we look at, we talked about already, bracketed markets or channels. Okay, we have fractals that we look at in the market, which are part of the 1, 2, 3 patterns. We can have reversal day pivot points that may be providing us an excellent entry opportunity, or maybe even we're already in the trend and it's getting ready to back off and we have a reversal day pivot point that we look at. We look at markets breaking even simple trend lines. That can be an indication that the trend is starting to get tired or exhausted. We use the Elliott Wave, as I said, and Fibonacci price levels. These are all the types of dots that we try to connect, okay? This is just a quick example, okay, of the kind of channel that we scan for and look for and then wait for the market to break out of. We don't want to put you in this market when prices are inside that red and green line on the chart because that's inside a channel. And basically you could sit in that channel for weeks or months depending on the time frame. So you don't want to waste your capital like that. Instead, wait for the market to break out of the channel, then start to move in for a trade. And again, we use a variety of the art software to do that to help us get into the markets. So we scan. Channels are a great way and a great simple scan to do on a variety of different time frames. Here's another one where the market was scanning. So you don't take any trades inside the channel. Wait for it to break. But now what you do is when you find a channel that hasn't yet broken, you need to keep track of the market because you want to constantly watch it. So in your MetaStock platform, you can set that up with an alarm system. So when it breaks either the upper or lower band of the channel, it alerts you and then you can start paying attention to the market more closely. Otherwise, you just have the alarm set and you don't worry about it until the alarms are broken. Elliott Wave, basically what we do with Elliott Wave, and we're going to cover this very simplistically here today, but in Elliott Wave, a trend is made up of 5 waves. And waves 1, 3, and 5 all go in the direction of the trend. And this is an example of a bullish trend, but if you inverted this trend and pointed it downward, it would be a bearish trend. So they look exactly the same, basically. One is up and one is down, but they occur both in bullish and bearish trends, and they're made up of 5 waves. Waves 2 and 4 are corrections in the dominant trend. They are not changes of trend, they are just corrections. Usually our trend lines are drawn right up under 2 and 4 many, many times, and that will mark the major part of, or the dominant trend line for that market. But it's kind of interesting to note this. I've studied it for a long time, probably going on 15 years now. I've been using it, and it's just been a great way to determine price target zones and determine really a roadmap of where the markets are going. It's not always clear, all right? So if the Elliott Wave is not clear, chances are we will avoid that market. So again, one of the methods of doing well in this is going with trades that are clear. They're easy to see the Elliott Wave. They're easy to see the trend emerging, all right? It's more difficult to trade a choppy market. We all know that. And if that's the case, then why bother? There's so many markets out there that are clear. You just got to find them, and you got to know how to look for them. So this is really basically an interesting model, because you notice in the pullbacks, which are waves 2 and 4, called the corrections, they all come in usually come in ABC corrections. They're more complex corrections, of course. But this is the idea of what we look for. So when we have a pullback in the market, we can use our Fibonacci retracements to get an idea on where wave 4, for example, should end, because that's around 31.8 to 62.1%, with a minimum being 38.1. If it goes usually beyond 75%, we're probably in a different wave count. And if it dips below 2, then you know you're definitely in a different wave count. Wave 2 can retrace anywhere from that 38 to 100%. So it has a little bit different characteristic than wave 4, which is important to know because that may affect where we put our stops. All right. So a lot of little things to consider, but one of the nice things is that our service that we have, where we come up with these key stocks, Forex, futures, and ETFs, is that we do this kind of work for you. We provide the stops based on this kind of analysis. And then also you can use this as a watch list, so to speak, and even refine it with your particular trading approach. A lot of folks do that. All right, Fibonacci, a little discussion on Fibonacci. It's really everywhere, okay? Not only in the markets. It's a phenomenon of nature, all right? And here's an example of it on a hurricane, okay? And when I say everywhere, I really mean it can be found everywhere. And this is a classic, but this is a girl's hair waving in the water following the arc of the Fibonacci on this one. Of course, this probably took them about 20 times to get that perfect, but you get the idea. Anyway, this is a good one. It wakes you up anyway. All right, so let's move on. All right, identifying key price levels. And here's an example on the current Dow Jones Industrial Average that we're looking at. And we had a key level of support that we were watching, 14,551.27. All right, and we had at that particular point, the PTF was negative when this chart was taken, and the owl was negative, and the market did come down further, all right, and then reached a bottom, which we'd hoped would happen before 14,551.27, because we don't think the uptrend is quite done yet. We think it will get into that wave 5 target zone. If it drops below that price level with the arrows pointing at it, then chances are the trend is done, but it hasn't done that yet. So based on this, this is going to skew our opinion to find bullish trades until we get below that key level of support. So we're looking at broader based indexes like the Dow in order to help us align ourselves with the market. So this is the kind of thing that will help us decide when we should start looking more for short trades versus long trades. Here it was a 60-minute time frame on an S&P E-mini, which was indicating a bottom. This was taken a week ago, which was indicating a bottom coming up before we've had the bullish week. And so we hit that target zone, as you can see. It skidded around for a few days and then headed back up. So we kind of expected that because that was coming down to a wave 5 on the 60-minute time frame. So that was giving us an indication that we were getting ready to move to the upside. Again, we like to look at the 60-minute chart to give us an idea of what may happen for the week or the next couple of weeks, whereas the daily chart will give us an overall view of target zones and a little bit longer time frame. Here's something on Apple that we were looking at. We had a wave 5 target zone hit beautifully, and then it started selling off, and notice during the sell-off that it was starting to take out all the key levels of support on the previous wave 5 uptrend, which is your first indication that the trend could be changing after hitting a wave 5 target zone based off Fibonacci extension. And then notice the owl at the bottom, which is the histogram. That is negative, and so is the PTF. And the owl and the PTF are available for MetaStock, and they're great tools that you can add to your current trading approach. We have videos on our website on how to use them and how they work and so forth. So a lot of folks have those on the MetaStock platform, even though they may be using some other form of entries and exits. Risk control. I want to cover this a little bit because risk control, I think, really is the holy grail of trading. And I think it's important to have a good risk control procedure for every trade. One of the ways we do it is we basically use something called the trade size calculator, which I developed, which has calculations built into it to calculate your trade size based on your win-loss ratio and also your payoff ratio. And that will calculate your percentage. And then from there, you put that percentage in the calculator. And on this example, it was 2%. And from there, here's the 2%. I'll try to get that over here. And from there, you can actually fill out your entry level and your exit level. And when you hit calculate here, it tells you on this trade where your entry is 1168.25 on the S&P E-mini, and your stop loss is at 1162.25. The contract size should be 3, and if the trade does get stopped out, you're going to lose a little under $900, and 2% of the estimated $50,000 account size in this example is, of course, $1,000, so that keeps you under the risk of ruin there. So on this example here, the raw risk is $5.75. So what's interesting is if you get a trade setup where your entry and your exit is closer together than $5.75, and all the variables are still the same in the calculator, well, that means you're going to have a larger trade size because your raw risk is closer together. So it doesn't matter the distance from your entry and your proposed initial stop, because whatever that distance is, the calculator will take that into account and deliver the trade size according to keeping the risk at 2%. So that's important to know. And just here's an example on a trade here where we actually had 2 entries. We had one down in the A area, and the only reason I mention this is because there are times when you can add into a trend, and you can do it the right way without incurring any more trade risk. And in a case like this, when we enter in on point A here, our initial stop loss is down here. So we use the calculations from the trade number 1 on the risk control calculator. All right, so that put us in initially. And then as the market moves up, we've got some areas we could scale out if you wanted to, but that's for a different webinar. But then again, we have another pyramid here, another green colored bullish pyramid that we could put our new stop loss, trailing stop loss under. And the idea here is that because the new stop is higher than our initial entry down in point A, the trade risk is gone. So now we're free to add another 2% risk to the trade and increase our trade size. And we have a whole formula on how to do that, but basically here's the trade size calculator calculating that. But the idea here is then you've increased your trade size, but you haven't increased your risk. So these are the kinds of things that we take a look at when we're in position trades to see if it's a good idea to be adding into the trend again or not. Here's one AAMRQ. We happened to get in this one early. Okay, enough. We waited for a breakout and then a good entry point. But the interesting thing about this one is it was bought out, okay, eventually. So we got a nice little boost on this of 133% here. Okay, so the performance using these types of techniques, okay, all used together, this year to date is 909.55%. And I'm going to put a link up here now that where you can actually go and take a look at not only the offer associated with this service, but also the actual individual trades. And then then on that sheet with the trades, we also create a summary. In other words, how many days do we stay in the trade, in winning trades? How many days do we stay in losing trades? And then we break the percentage down into a monthly basis, etc. And then also we give you each individual trade on that, and you can actually go in, and if you want to calculate any other results, you can do that because all the trades are there. So you may want to check that out. All right, so this service for $49.98, we got a ton of subscribers worldwide. It's very moderately priced, and I've done that on purpose. I've kept it low so everybody could basically afford it. And the idea behind it is we have so many subscribers that at $49.98, okay, I'm getting paid well for providing a really good service, and you're getting a service that's affordable. So it's kind of nice. It's kind of like when Henry Ford made the Model T car. The purpose of that car was so everybody could afford it. And because everybody could afford it and it was a good car, he built a lot of them. And that same concept is behind this service. We want to keep it at a low price, all right, and we like to do it even at a lower price for our friends like MetaStock that sponsor our webinars for us. And so we want to give you even another $20 off, so it's $49.98 instead of $69.98. And you can cancel at any time, all right? Each subscription is renewed automatically each month. If it's, you cannot, we do not do any refunds, so once you're charged for a month, all right, you can't get a refund on that, but you can cancel, so you're not charged again, okay? But there are no refunds on already processed payments for obvious reasons. So if you go to that link, you can check it out and sign up, and the sign up's pretty easy, and then you're locked in, and every month you get charged the $49.98, and then of course you get a login area, a login link and username and password where you can access all the trading picks 24/7, and I update them every Sunday. We don't micromanage these trades. We update them every Sunday, and you can go in and see all the updates. If we need to move a stop, we'll move a stop. If we need to adjust an entry on a pending trade that's still pending, we'll go ahead and mark that as well. So it's pretty cool. It's pretty efficient. And the nice thing is once you have access to the inside, then you can just go in there whenever you want. All right, and that's really it. That's primarily what I wanted to cover today, to kind of give you an inkling into a service that can provide some really good setups each and every week for you to actually trade, whether you're a Forex trader, a stock trader, a futures trader, or an ETF trader. And you can also use your current trading system. You can use our entries as suggestions, and you can use our stops as suggestions to your current system. Okay? Roland, if you there's one question coming in from Roland. What are the breakdowns of stocks, ETF, futures, and currencies? Go back to that page, look at all the trades you want that have meaning for you, and you can actually do all the calculations yourself. We give you every trade we've taken. Okay? Dennis is asking, what is the cost of the OWL and ART software? Gene, why don't you put a link up there to the OWL and PTF software on the website. If you go to the traderscoach.com website, you can learn more about our software. The OWL is $797 for a lifetime license, and the PTF is $497. So that's $497 for the PTF, and the OWL is $797. Yeah, I'll put the link back here for you. I'm being asked to put the link here. Okay, there you go. All right, so we're going to have, Gene wants to have this offer good through Friday of this week. So if you want to get the service of $49.98, that price, you have to do it by Friday. Otherwise, the price will revert back up to $69.98. And $69.98 is still a great deal. Okay, Gene just put the prices up there. Okay. Okay, let's see. My question, please. Boy, there's so many questions, I don't really remember what it is. If we didn't answer it, please put the question back up and I'll get to it, okay? They've been coming in fast and furious here. Okay, I think I see your question. Is there one primary time frame you concentrate on when entering and exiting trades? Great question, okay? We primarily concentrate on daily time frames, all right? And really it's going to depend on what the market, what kind of market cycle we're in. We have the option to go lower, okay? We're probably not going to go higher because if you go to a weekly time frame, I wouldn't really justify that as a momentum trade, okay, so to speak. That's more of a long-term type of trade. Could be a momentum trade, but a longer-term one. So really we stick to daily charts, and we have the right to go a little lower if we need to, but primarily it's daily. Okay, that's fine. I mean, again, you know, what you can do if you prefer to use intraday charts and go a little more micro, you know, you could use our entries on the daily, and then if you feel you're getting a better entry on the intraday based on your trading approach, all right, and want to get in a little bit earlier, you can. But we kind of make our entries and exits off the primary time frame that we choose, and we tell you in the list what time frame we're using, okay? All right, well, Jeff, I think that pretty much covers everything, okay? I think I didn't want to make it too long because, you know, enough information is enough information, so to speak. But I think I got the question. So, you know, again, a pleasure being here. You guys have the link. It's good till Friday. And I just want to thank you, Jeff, for having me again here today.
Thanks, Bennett. We really appreciate your coming in. And we'll schedule another one real soon. Thank you.
Okay, great, great. All right, well, thank you, everybody. You guys have a great week, okay? Bye-bye.